Imagine two identical twins. Let's name them Mark and Dave, both 30 years old. They share the same job, earning exactly $75,000 annually. They live in identical houses next door, in the same suburb, and drive the same model gray sedan. On paper, their financial situations are indistinguishable. Yet, over the next 30 years, Mark will end up paying $250,000 more than Dave for the same lifestyle. Steve isn't intentionally wasting this money. He isn't losing it on bad investments or risky gambles. Instead, he's handing it over to banks, insurance companies, and landlords simply because his credit score is 640 instead of 760. This is an invisible tax that rarely gets discussed. While we often focus on income taxes and sales taxes, we overlook the so-called credit tax, which arguably causes the most wealth destruction in the American economy. My name is Ben, and I spend a lot of time analyzing how the financial system is gamified and rigged to prevent those at the bottom from ever moving up. If you pay your bills on time, but still feel judged by the system, or if you get anxious whenever your 3-digit score drops just 5 points after buying a new sofa, make sure to subscribe and give this video a thumbs up. Today, we're going to reveal the true nature of the credit score. It's not a measure of your morality, nor even your wealth. It's a reflection of how profitable you are to the banking cartel. And in the high-interest environment of late 2025, understanding this game isn't just about getting a good credit card. It could save you $250,000 that rightfully belongs to you. Here's something that might surprise you. The FICO credit score, as we know it, is younger than Taylor Swift. It was introduced in 1989. Before that, lenders made decisions based on human judgment. While that system had its own issues with bias and racism, the newer algorithmic system replaced human bias with cold ruthlessness. We've been conditioned to see this score as a foundational societal metric, but it's actually a recent invention created by corporations to standardize risk and facilitate debt securitization. In doing so, it established a caste system. Prime borrowers get access to cheap money, while subprime borrowers pay a steep premium simply for existing. Let's crunch some numbers because the implications are staggering. Buying a home, say a $400,000 house, is often the largest purchase in a person's life. If you have a stellar credit score of 760 or higher, you might qualify for the best advertised interest rate, let's say around 6%. But if your score is 620, considered fair, banks see you as a higher risk. They won't deny you a loan outright, but they'll charge you a much higher interest rate, costing you tens of thousands more over the life of the loan. That would be leaving money on the table. Instead, lenders add a risk premium by increasing your interest rate. At first glance, a 1.5% hike, raising your rate from, say, 6% to 7.5%, might seem insignificant. It's just a small percentage increase, right? But if you run the numbers on a 30-year mortgage for that house, that 1.5% difference can amount to roughly $120,000 in extra interest paid over the life of the loan. Consider this. You're purchasing the same home, with the same roof and the same yard, yet you're paying over $100,000 more than your neighbor, simply because an algorithm from 1989 labeled you as a higher risk. That's $100,000 that could have been invested in the S&P 500. Had you invested that amount over 30 years, it could have grown into $500,000 through compounding. The real opportunity cost of a poor credit score isn't just the higher interest payments. It's the potential to undermine your future retirement savings. It's wealth transferred directly from your pocket to the bank's bottom line. But the influence of credit scores extends beyond loans. This is where it gets eerily like Black Mirror territory. Your credit score has transformed into a reputation score. In many states, auto insurance companies use your credit score to set your premiums. They've determined through actuarial data that lower credit scores correlate with higher risk of accidents. So even if you have a perfect driving record, no tickets or accidents, and drive carefully, a dip in your credit score can still cause your insurance premiums to rise. Research shows that a driver with a clean record but poor credit can pay twice as much as someone with a DUI and excellent credit. Let that sink in. The system trusts a drunk driver with an 800 credit score more than a safe driver with a 600. This exemplifies the poverty premium in action. And it doesn't stop there. Landlords factor in credit scores. Utility companies require deposits based on creditworthiness. Even employers in sectors like finance, defense, and government sometimes check credit reports during background checks. You might be the most qualified candidate, but if you missed a few visa payments during a medical emergency 3 years ago, you could be perceived as irresponsible and overlooked. What was once simply a risk assessment tool for banks has evolved into a universal judgment of your personal worth. It influences where you can live, what you can drive, and even where you can work. The most perverse aspect of this system is how credit scores are calculated. They don't reflect your actual wealth. You could have $10 million in cash stashed in a safe, but if you've never taken out a loan or used credit, your score might be 0 or unscorable. To the algorithm, you're invisible, a ghost. Meanwhile, someone else might be broke, living paycheck to paycheck, buried in minimum payments. Yet their credit score could be relatively high because they've used credit extensively. If you constantly borrow money and repay it just in time, you're essentially a star player. The credit scoring system favors frequent activity and participation in the debt cycle. It disapproves of cash transactions and penalizes those who pay off loans too early. For example, have you ever paid off a car loan only to see your credit score drop by 20 points? That's the system subtly signaling that it preferred your previous behavior, paying interest. Once you stop paying interest, you're less valuable to them, resulting in a lower score. It's like a loyalty program designed for those perpetually in debt. Let's explore how the score actually works, because understanding it can save you money. The largest component, making up 35%, is your payment history. It's a binary factor. You either paid on time or you didn't. Missing a single payment can damage your score for years. The second most significant factor, accounting for 30%, is credit utilization, the ratio of your current debt to your total available credit. For instance, if your credit card has a $1,000 limit and you spend $500, your utilization rate is 50%. The scoring system views this negatively, perceiving it as financial desperation. However, if you call your bank to increase your limit to $10,000 and keep spending $500, your utilization drops to just 5%. The algorithm favors this scenario because it appears you have access to large amounts of credit, but choose not to use it. It's all about appearance. A key tactic is to appear as if you have access to millions, but have no desire to spend it. Additionally, there's the authorized user trick used by wealthy families. A parent with excellent credit adds their child as an authorized user without giving them the card or allowing them to spend. The child's credit report then inherits decades of perfect payment history, giving them a high score from a young age. This enables them to secure favorable loans easily. Conversely, children from families with poor credit often inherit bad habits and face higher interest rates, perpetuating economic inequality. This is a subtle form of inheritance. What if things go wrong? That's where credit repair services come into play. Sadly, about 90% of these services are scams. However, the underlying legal mechanism they leverage is real. According to the Fair Credit Reporting Act, all information on your credit report must be accurate and verifiable. If there's an error, say, a wrong date or misspelled name, you have the right to dispute it. If the credit bureau cannot verify the debt with the original lender within 30 days, they are required to delete it. This process allows individuals to clean up their credit reports legally. They're not demonstrating that they've paid off the debt. Instead, they're highlighting that the paperwork is disorganized. It's a legal loophole that the wealthy exploit daily for tax advantages. You should consider leveraging similar loopholes for your credit strategy. Now, I want to address the philosophical side of this discussion. Some of you might be fans of Dave Ramsey and believe, Ben, credit scores are only for debt, and debt is foolish. Just use cash. I respect that mindset. If you can buy a house outright with cash, do it. Opt out of the system entirely. However, for 99% of viewers, a mortgage will be necessary. You'll need insurance. And navigating modern America with a 0 credit score makes life much harder. Higher deposits, rental denials, Constant friction. Instead of boycotting the credit score, the smarter move is to manipulate it. Think of it like a frustrating video game that you need to master quickly to reap the rewards and move on. So, how do you hack this system? First, automate everything. Since payment history accounts for 35% of your score, set all bills to autopay the minimum amount. This creates a safety net. You can pay off the full balance later manually, but autopay ensures you never miss a payment due to forgetfulness. A single 30-day late payment can damage your score for up to 7 years. Second, play the limit-raising game. Every 6 months, request credit limit increases from your credit card issuers, especially if your income has risen. Most of these requests are soft pulls, which don't harm your score. By increasing your available credit, you improve your utilization ratio, creating a buffer that keeps your score stable even during expensive months. Third, never close your oldest accounts. The length of your credit history makes up 15% of your score. If you have an old card from college that you rarely use, keep it open. Buy something small once a year to keep it active. Closing it erases its history and shortens your average account age, which is like erasing years of experience from your credit resume. Keep those old cards open. They serve as foundational anchors of your credit reputation. The key point is this: don't treat your credit score as a measure of your self-worth. It's a tool, a VIP pass that grants access to lower interest rates. Protect it fiercely, not because you care about impressing the bank, but because you refuse to pay unnecessary ghetto taxes, that extra hundreds of thousands over your lifetime. Instead, channel that money into investments that grow for your financial freedom. Don't fear the score. Master it. Keep your utilization low. Dispute any errors, since about 20% of reports contain mistakes, and recognize that the system is designed to drain wealth from the unorganized. By getting your finances in order and understanding how the algorithm works, you become less profitable for them in the short term, but highly trusted in the long run, leading to lower interest rates. That's the sweet spot. If this video has made you realize you've been playing the credit game blindfolded, share it with a friend. Banks rely on our ignorance, counting on us accepting high-interest loans because we believe we don't deserve better. Let's stop handing them our money. Thanks for watching, and I'll see you in the next one.